The most successful retirees I've worked with, they're not always the ones with the biggest portfolio or the fanciest spreadsheet, but they have one thing in common. They track 5 key numbers, and once you understand these numbers, your confidence in retirement goes way up. Hi, I'm Jim Martin. I'm a financial advisor and the founder of Martin Wealth Solutions. And over the last decade, we've helped hundreds of families retire. And in that time, I've noticed a pattern. The people who feel the most in control of their retirement aren't the ones who obsess over the stock market or chase investment fads. In fact, they're the ones who focus on a few simple metrics that really move the needle. So today, I want to walk you through those 5 key numbers that matter most when you're getting ready to retire or have already retired. So let's dive right in. Number 1, your fixed cost. This is a must-have number, and honestly, it's the one most people underestimate or don't track closely enough. When you're working and earning a steady paycheck, it's easy to let the spending blend together, but in retirement, it becomes critical to know exactly what it takes to keep the lights on. No fluff, just the essentials. Fixed costs, well, they could include your mortgage or your rent, utilities, health, auto, home insurance, transportation, groceries, debit payments, any essential subscriptions, just like Netflix or services. Why does this matter? Because underestimating your costs can lead to stress and potentially overspending. Overestimating leads to fear of maybe I should just work, maybe just one more year. Now, number 2 on our list, your net worth. I think this is really important to keep track of. If your fixed cost is your monthly picture, your net worth is your big picture dashboard. Net worth equals assets minus liabilities. Now, why does this matter? Because it helps you see progress, spot problems, and feel more grounded in financial reality. When you track this number over time, say quarterly, you start to notice trends. Is that investment account shrinking? Is your debt going down? Is your portfolio keeping up with inflation? We help our clients track their net worth, but with some work and some spreadsheets, this is something you may be able to do on your own. Now, number 3 is investment allocation. Now, here's where things get a little more technical, but stay with me. Tracking your investment allocation means knowing your percentage that your portfolio is in cash and equivalents, in bonds or conservative investments, in stocks or growth assets. Too often we see investment portfolios where every account, whether it's your IRA, your Roth, your 401k, your brokerage account, is invested exactly the same. But that's a missed opportunity. In retirement, you want purpose-driven portfolios. Maybe your Roth IRA is invested for long-term growth, while maybe your 401k is a little bit more conservative because it may be the first place you'll draw from. Now, your brokerage account might be balanced to fund short-term income needs. Having the right mix in knowing where your assets are at, well, that helps you manage risk, reduce taxes, and I believe increase your peace of mind. If you're not sure where your investment allocation is at, make sure you connect with somebody you trust to help walk you through that. Number 4 on our list, the years of safe money. This one's a game changer. It's the number most retirees never hear about. We refer to it as your war chest, and it answers the question, how many years could I cover my income needs without touching my riskier investments? Because believe it or not, markets do go down. We want to make sure we have a war chest. Let's say your fixed expenses are $60,000 a year, and you've got $50,000 in cash, $130,000 in bonds or conservative holdings. That may give you 3 years of safe money, and that's enough to ride out most market downturns without having to sell low or panic selling of stocks. This isn't just a theoretical number. I've had clients call me during market downturns, and when we reviewed their war chest and they saw they had 5+ years of coverage, you could hear that stress leave the room. So I think this is a really, really important number to track. Now, number 5 on our list, the rate of return you need to get on your money to never run out of it. This number is all about clarity. It answers one of the most important questions. How hard does my money need to work to support my lifestyle without running out? That's the number 1 fear most retirees have, is running out of money. It's not about chasing the market. It's knowing whether you need 3%, 5%, or 7% to meet your income needs and your legacy goals. We run this number for almost every retirement plan we build. And here's what we find. If your required return is 3 or 4%, well, that means you have a lot of flexibility. If it's over 6%, you may need to rethink your spending strategy. And if it's over 7%, that's a red flag because you're depending too heavily on market performance. This number helps take some of the guesswork out of financial planning and brings logic into your withdrawal strategy. And let's make sure we build a portfolio with purpose, not fear. So let me recap those top 5 numbers. Get your pen and paper out, and it'll be in the show notes as well. Fixed costs. Know what you need each and every month. Your net worth. Make sure you track that big picture because it's going to let you know about your financial health. Investment allocation. Understand how your assets and your investments are positioned. Number 4 on our list, your years of safe money, your war chest. How much money do you have in your war chest so you can ride out those downturns? Number 5, the required rate of return on your money. Know how hard your money actually has to work for you to never run out of money. Hey, I hope you found value in today's show. If you're ready to retire, if you're already retired and you're not tracking these numbers and you want to make sure of where you stand, go ahead and reach out to us at martinwealth.com. Thanks for watching. Again, if you liked the video, make sure you like and subscribe, and we'll be back next week.